So 2024 is coming to an end, and that also means the end of another tax year. And if you are watching this in 2024 before the year's end, you still have opportunities where you can save money on taxes. So here in this video, I'm gonna go unpack a few ideas that you've probably never heard of that could help you save money on taxes for the year of 2024. Now, my name is Sam Kwok, one half of the Kwok Brothers, entrepreneur, real estate investor, and our company offers financial services and education. But that being said, I do wanna let you know that I'm not a tax professional, I'm not a CPA, I'm not an accountant. So please be sure to consult with your CPA or your tax professional before applying any of the ideas and strategies that I share with you in this video. Now, I'm gonna break this video down into two major parts. One is for individuals who have a regular W-2 job working for a company or employer. The second part will be more applicable for employers, or if you have a small business, self-employed, maybe you do Uber, or you have a side gig, or maybe you have an e-commerce store that you sell certain merchandise through online retail. So let's go and start beginning to unpack some of the ideas on the individual side. Number one is a little bit more obvious, and you've probably heard of this many times through all the YouTubers, and that is to maximize your qualified retirement plan contributions. Now, if you're making contributions to a traditional 401k, IRA, HSA, you technically still have till April 15th of 2025 to make it count towards the tax year of 2024. So technically you still have time until April 15th of 2025 to make those deductions. But a little quick memo on the 401k, if your employer matches your contribution in your 401k, definitely do consider contributing to your 401k a little bit more aggressively, because matching from your employer is like virtually free money that you should never leave on the table. So definitely take advantage of that, because it could certainly be an accelerant to helping you grow your investments for your retirement. Now, a second helpful idea on the individual side is to maximize and use your HSA, also known as a health savings account. Now, although I'm not a tax professional, I have many clients in my financial services firm that simply don't use this tool. And I know many of my tax professional friends will agree with me, and that is that the HSA is probably the most underutilized tool when it comes to tax savings. Now, unlike the other qualifying retirement plans like 401k or an IRA, the HSA is unique in the sense that the contribution to the HSA could be deducted in taxes, the growth inside the HSA is also tax deferred, and most qualifying medical expenses that you pay using your HSA is also tax free. So if you know that you have certain medical expenses like prescription drug and even certain over-the-counter drugs that you use for, common cold or flu, the HSA can be used to pay for those types of medical expenses. I mean, these are the expenses that you were gonna pay anyways post-tax. Might as well contribute to an HSA and use the tax advantages that you have through the HSA to pay for those medical expenses tax-free. Now, in order for you to even open an HSA, yes, you do need a high deductible health plan, meaning that you do have to have a health insurance plan that comes with high deductible. And often high deductible plans are cheaper when it comes to the premiums versus a lower deductible health plan. So the high deductible health plan combo with HSA could be very beneficial, especially if you don't frequent the hospital a whole lot, but you tend to have a higher cost when it comes to over-the-counter drugs or certain medical devices that you buy that is qualified as part of the list of qualifying medical expenses. So definitely consider the HSA to be part of not only your tax plan, but it could certainly be something that's incredibly useful for your future retirement, but overall for your medical readiness plan. Number three is the unreimbursed expense for employees. Now, after the Tax Cuts and Jobs Act of 2017 was enacted, this deduction was largely done away for most workers, except for a handful of jobs that still can take advantage of this deduction. Now, I won't get into too much of the detail because this probably won't matter for most of you, but if you're in the military as a reservist, if you are an educator like a principal, teacher, or some kind of administrator at a school, you might be a qualifying performance artist like an actor or an artist. There are some nuances to that. Or you might be a disabled employee with certain impairments and expenses that relate to performing your job. Then certain expenses that are related to your job that are necessary and ordinary could be deducted and can help you lower your tax liability. So if your job fits into any of those categories, definitely do some more research and talk to your CPA or tax professional about taking advantage of those tax deductions. Number four is making charitable contribution to your favorite non-for-profit. Now, this could be a religious organization or a certain humanitarian aid organization. You can make not only cash contributions, and a lot of people don't know this, but you can actually donate a certain appreciated assets like stocks, mutual funds, cryptocurrency, real estate, certain assets that you hold in a brokerage account. You could donate those assets to your favorite not-for-profit to potentially avoid capital gains taxes. So traditionally, when we talk about giving money to a not-for-profit, we think about cash, but there are also qualifying professions where you could donate time and make deductions out of that as well. So be sure to talk to a CPA or tax professional if you meet those criteria for certain professions to donate their time and count that towards tax deduction. Number 5 is technically not a deduction, but even better, it's a tax credit. And if you made any home improvement that made your home more energy efficient, then yes, you could qualify for tax credits that offset your tax liability altogether. So if you installed solar panels or certain insulation or a more energy efficient door, those types of improvements could qualify you to earn tax credits that ultimately offset any tax liabilities that you have. Now, personally, I love tax credits more than just tax deductions, whereas a deduction simply lowers your taxable income or certain treatment of income that could be taxed in a certain way. But on the other hand, a tax credit makes a direct impact in lowering your tax liability. A good way to think about a tax credit is think about it as a gift card that the IRS gives you that ultimately offsets your tax liability. So say after doing all of your tax calculations, all the deductions, you owe about $3,000 in taxes. Well, if you receive a tax credit of $1,000, you go from owing $3,000 of taxes only down to $2,000 with a $1,000 tax credit. And yes, in theory, if you owe $3,000 in taxes and receive $5,000 of tax credit, then you actually get $2,000 in your pocket. So personally, I like tax credits better than deductions because the tax credit affects directly the tax liability, whereas deduction lowers your taxable income. So up to this point, those have been some ideas for individuals to potentially lower your tax liabilities. Now let's go and shift to some tax saving ideas for business owners as well as self-employed individuals. Number 1 idea is quite simple, and you might already be doing this already, and that is to pay your business expenses early. So if you have certain expenses that you know you're going to pay in January of 2025 or the following year, why not pay them early now so that you can count them towards your business write-off and deductions for the year of 2024? So say you have certain contractors that you know they're going to be there next month and they're going to perform services for you in January. Well, one potential way that you could lower your tax liabilities and take a write-off is to prepay for their services, or at least to prepay hours that they're going to perform in the month of January. Another classic idea is to prepay for certain supplies that you're going to use for January or even February, or prepay certain software expenses that you know you're going to use in January and claim them as an expense for this current year, 2024. Now, you might be saying, well, Sam, I'm gonna pay for those expenses anyways. Doesn't that mean that I'm gonna lower the amount that I can deduct for 2025? In theory, yes, but by prepaying these expenses early, you're basically saving money today as opposed to saving money tomorrow, and henceforth, it's just a matter of time value of money. If we can capture tax savings today that we can use towards investment for tomorrow, then our dollars could be worth more today than that it is savings for tomorrow. So that is one idea that you can run with your tax professional or your CPA to look at what expenses can you prepay today in 2024 versus 2025 and claim expenses early to ultimately save money on taxes. Number 2 is something called income shifting, aka paying your family members and kids. Now, the basic premise of this idea is that if you have family members that can render services to your business, that you can actually pay your family members, i.e. your kids, and save some money on taxes and write it off as a business expense. So say you have kids that can perform certain services for your business, they do have to be age appropriate, necessary and ordinary for your business. So for example, let's say you have a teenage child who's under the age of 18 and they have certain gifts and talents to be able to edit videos. So with your business, if you hire your child who can edit videos and have that child perform services, video editing services for your business's marketing efforts, you could pay them up to $14,600 this tax year, 2024, and claim that expense as a write-off for your business, which ultimately reduces your tax liability. Now, why $14,600 to be exact? Well, $14,600 happens to be the standard deduction limit for an individual for the year of 2024. And if that child is under the age of 18, they technically don't have to file taxes, which means they don't have to pay taxes on that $14,600. Now, there are nuances and technicalities to this where I do have a separate video where we get into more details on this, and be sure to talk to your CPA and your tax professional about these nuances as well. But if you're in the situation where you can pay your child to perform ordinary and necessary age-appropriate services to your business, then you could shift your income of up to $14,600 per child that's performing the services over to your kids that technically don't have to pay taxes. So if you have 3 children that are able to render services that are, again, age appropriate, ordinary, and necessary for a business, that's 14,600 times 3 that you can claim as expense and lower your business taxable income down while still keeping the money in the family. And with the payments that you make to your children that are performing services to your business, now they can pay for all their school expenses, all the things that you were paying out of your pocket post-tax dollars, and now you have a legal, ethical, moral way to not only reduce your taxes, but teach your kids about the value of work and the value of budgeting and making sound financial decisions. And last but not least, number 3 idea, if you are a business owner or self-employed, is the R&D Tax Credit. If your company or your business was involved in certain research and development activities like building a new software and application, inventing new products, inventing new manufacturing equipment or new hardware, then yes, your business or your company could qualify for tax credits for those types of activities and expenses. Now, I personally didn't know about this tax credit until a few months ago, and I started working with my CPA and tax professional to claim these tax credits to lower my tax liability. And let me tell you guys that I was pleasantly shocked and surprised that I could qualify for these types of tax credits and offset my tax liability. So don't underestimate or don't overlook the fact that there are these niched tax credits that you can take that also might be more fitting for your industry and may not be available for other businesses. So it is worthwhile to take some time to go and look into these tax credits or tax incentives that are out there for your business, for your industry that could lower your tax liability. So those have been some of the ideas to lower your taxes and save some money on taxes, whether you're an individual or you're a small business owner or you own a company, self-employed, whatever the case might be. Those are some of the ideas. Now, if you want to get ahead in the year of 2025, the best thing to do for taxes and saving money is to document. If you are an individual, get a budgeting app, okay? There are some of these really cool budgeting apps these days that make budgeting super easy and automated. And personally for me, it takes no more than 10 minutes to review and do my budget. It makes it so easy to make these deductions and to look at what spendings I could claim as tax deductions to help me save money. Now, if you're on the self-employed side or you're a small business owner, there's no excuse as to why you should not have a bookkeeping software. You gotta have a bookkeeping software to track your expenses, to track your income. You don't wanna miss out on the opportunities, not only to save money on taxes and find tax deductions, but it's incredibly important to have accurate bookkeeping and record keeping so you can make sound business deductions, make the right investments for your business, and just clearly see if your business is profitable or not. So document. And if you need help with those things, be sure to work with your CPA or your tax professional to get the help for bookkeeping, record keeping, and budgeting. Those are things that you should absolutely have. So with that being said, I hope these last minute ideas help with the year of 2024, and we'll have videos out for you guys for tax law changes in 2025 that you should know that ultimately impact how you do your taxes and how much you'll pay for 2025. So definitely stick around, subscribe, and we'll see you in the next video.